I bought more shares of Facebook. You should be greedy when others are 6 US companies, 2 Chinese. Catch the falling knife and buy Carnival Corporation stock. Order your shares from the one you like the most. How you doing, guys? It's Damien here. Warren Buffett is an American investor and CEO of Berkshire Hathaway. He is also considered one of the most successful investors in the world and has a net worth of $81.7 billion US, making him the 4th wealthiest person in the world. In this video, I will show you my latest transactions and I will explain to you how I apply 5 lessons from Warren Buffett in my stock market investing. The first lesson is that you should be greedy when others are fearful. Everyone is panicking and selling their shares. But you can see that what China did for stopping the spread of the virus worked. It allowed stopping the spread of the virus. There is already more than 70% recovered from being sick in China. So there are ready solutions, and maybe it will require more countries to put restrictions on people's travels. But in the worst case scenario, it will require perhaps a month of stopping businesses. The effect for the majority of industries is not going to be severe. I took advantage of the recent sell-off and added more than £5,000 to my investing account. When everyone is talking about how bad stocks are doing, it is a contrarian signal. My mother or colleagues from my office have been terrified of what is happening in the stock market. People who do not invest in the stock market have been asking me how my stocks are doing. My response was that my investments are great and I bought stocks 15% cheaper than I could just a month ago. I invested my newly saved money for much lower prices. People have been jumping to buy shares of oversold companies from the tourism industry recently. Many financial commentators have been posting videos in which they showed that they bought stocks of airlines or cruise ships companies. Potentially, it may be a good idea. These companies experience the most significant drop in their share prices. But I do not try to catch the falling knife and buy Carnival Corporation stock as many vloggers do. So far, it seems that it did not work out well for them. These investors expect that because these companies were plunging the most, similarly, their businesses are going to recover quickly. Maybe that is going to be the case, I don't know it. But what I know is that I would not feel comfortable holding these companies if they continue going down further. I just do not have enough conviction that it's the right choice. Often I read about some company with potential, but what I do is that I compare it with my current investments. And then I think and analyze this company. It is often the case that the company has the potential to make me, let's say, 10% annually. But at the same time, I can get more from my current choices. It shows that buying shares of that new company would only make my investments results worse than without making any changes to my portfolio. And also it would distract me from my circle of competence. So what I did is that I bought more shares of the companies I already have in my portfolio. I just used the recent correction in their share prices to increase these positions. I bought more tech stocks. That is my area of expertise. I bought shares of Tencent, which is one of the biggest technology company in China, next to Alibaba. I also increased my positions in gaming companies, Playway and 10 Square Games. As you can see from this calculation, so far these transactions worked out well for me. My new positions went up overall by 5.2%. The positions I sold went down on average by 11.5%. Smash that like button for the YouTube algorithm. It will help reach more people and will encourage me to give you more useful content. Also, I bought more shares of Facebook and Lyft in another investment account, but these positions are much smaller. Warren Buffett believes investors should buy stocks within their circle of competence. He stressed the importance of looking at companies that are within his areas of expertise to avoid large investing mistakes. For Warren Buffett, that area of expertise is financial industry, insurance companies and banks. I feel comfortable with my investments in technology businesses. I read plenty of materials about the companies I own. I have read their financial statements and I have followed their quarterly financial results. Apple stock went down. That's great. The company will be able to buy back more shares for a lower price, which means that my ownership in the company will increase even more than it would increase if there were no correction in the stock price. CD Projekt has been oversold after moving the release of the next game. That's awesome. I increased my position in this company much cheaper. I focus on what I understand best. I focus on the companies which I have been analyzing for a long time. I also use the products of these companies and I know exactly how these companies make money. There is a widespread belief that says don't pull all of your eggs in one basket, diversify. But Andrew Carnegie wrote more than 100 years ago, put all your eggs in the one basket and watch that basket. Let's think about it. Can you have 20 of your favorite shirts? Think about such an exercise. Order your shirts from the one you like the most to the one you like the least. If you wear them day by day in such order, you will notice that you feel better when you wear this from the beginning of the list. So why not cut your list on half and wear only those from places 1 to 10 and just wash them more often? Or if you want to have the same quantity of shirts, just when your new shirt is on one of the top positions, buy an extra one and get rid of the worst from your wardrobe. What is interesting, you can do the same with your stock market investments. And when I started following the same rule, my investment results got much better. In that way, you select only the best businesses and you do not have mediocre companies in your portfolio. I currently own just 6 US companies, 2 Chinese companies, 6 Polish companies, 1 company from the UK, and company from Russia and 1 Canadian company. I review these businesses and I sell the worst performers and I usually buy more shares of the best performers, which are the companies in which I see the biggest potential at that time. These are the businesses which will make me the most money. So it is 17 companies. It sounds like quite a diversified portfolio. Yes, but it is not so diversified. Almost 90% of my wealth is within 9 companies only. My 9 most significant positions consist of 87.6% of my overall portfolio. Similarly, Warren Buffett's 9 biggest positions consist of 80.2% of Berkshire Hathaway's portfolio. The biggest argument for diversification is protection from risk. By buying a multitude of stocks, you're indeed lowering the likelihood that any one stock would fall and wipe out a big chunk of your portfolio. But you're still not protected from overall market risk when the whole market tumbles. To Warren Buffett, over-diversification presented a low-hazard, low-return situation, and that was the reason he did not follow this rule. George Soros said, if the stock goes up, you buy more. You don't care how big the position gets as part of your portfolio. If you get it right, then build. I notice that the more focused I am and do not try to diversify my investments, the better are my investing results. That is why now I prefer to focus on the best businesses only. Be humble and be able to admit that you made a mistake. When investing, you try to make the best decision on the current moment, but you do not know everything. As time goes, you get more information and the overall situation is changing as well. The sooner you realize your mistake and get rid of the company you wouldn't buy now, the better. Your perception of the company may change as you have more access to the new information. You need to be able to admit that you made a mistake. Such a process was behind selling my commodity companies and replacing them with technology businesses. It is crucial to be able to say that you were wrong to buy the company in the first place. I think the inability to admit your mistakes is the biggest problem I see among my friends who are investors. They hold stocks of the companies even though the share price did not move at all during a few years. Or even worse, they hold the stock of the company which plunged 60%. They hold because fundamentally the company seems to be cheap. It might be cheap, but there is often a reason for such valuation. The reason they cannot see now, like the changes in the industry or emerging competition. That is what happened to Warren Buffett when he tried in a new industry. Buffett has often said he avoided tech stocks in the past because he didn't understand how they were making money and whether they would be able to do so over the long term. When he finally invested significant money in IBM stock, for years Buffett was a true believer in IBM's business, but a few years ago he sold shares of this tech company. Warren Buffett said that he didn't value IBM the same way that he did 6 years ago when he had started buying. All investors, even Warren Buffett, must acknowledge that mistakes will be made along the way. He recognized his mistake in buying IBM and bought Apple shares instead, which was a much better investment. I heard it years ago that the US stock market is very expensive and it is a good idea to stay away from overpriced American stocks. Maybe some companies are expensive, but you can find businesses which are reasonably priced. Many of my friends stay away from the stock market. They think that the only direction for it is to go down. Well, I do not focus on the overall stock market. I focus on the great businesses which will make me rich. And so far, it has worked out well for me. I do not try to predict the peaks and lows of the overall stock market. You can see from this graphic that every few months there were some reasons why not to invest in the stock market. Let's just name a few. 20% US stock correction in 2011, US government shutdown in 2013, Ebola virus in 2014, Brexit, trade war, inversion of the yield curve, and now we have coronavirus spread across the world. Stock market corrections are happening every few months, and as you can see, the stock market keeps going up. Recently, 89-year-old Berkshire Hathaway CEO Buffett said he had been a net buyer of stocks every year since he was 11, a period which has seen 14 US presidents. So if you do not want to listen to my advice to not try to time the market, listen to the advice from this successful investor. Just focus on great businesses which will do well whatever happens. I hope this video gives you a good reminder of the rules of one of the most successful investors. In summary, I would just say something against index investing. If you spread yourself too thin, you will compromise your results and your likelihood of beating the market. Many YouTubers preach the value of index investing. Just buy the whole market and be happy with being average. That's fine if you're aiming for average returns and don't want to bother trying to beat the market. It's unlikely though that you will be able to accumulate serious wealth by utilizing that strategy. Following Warren Buffett's rules made me become a better investor, and I hope it will help you too in your investing journey. Let me know in the comment below which advice resonates the most with you. If you enjoyed this video, make sure to subscribe or feel free to add me on Instagram, Stocks and Freedom. Thank you so much for watching, and until next time, happy investing!